Thank you. So, whenever we go ahead and plan, we generally plan to succeed, right? Nobody plans to fail. But generally, when we don't plan, we go ahead and fail, right? And when you look at National Pension Scheme, which is a great solution of Government of India, we will try understanding more about it in this particular session, but I would like to first share a few facts with all of you, and that's something which is important. So as this particular slide itself talks about, the fact that every age and every stage, you should plan for something which is your golden years. You cannot go back and reverse everything and come into the present, right? So that's the reason it is important to plan and succeed. This is something which is an eye-opener. Some of my other colleagues in the previous sessions talked about it, right? So if you look at today in terms of aging population in India, if you look at it, it is increasing rapidly, right? On the other side, the entire global numbers, if you look at it, the fertility rate is going down. So as the fertility rate is going down, India is not left. India is also part of it. So the aging population proportion is relatively much more higher, right? And that's what this slide basically talks about. Indians are increasing rapidly in terms of, age and also their life expectancy. So life expectancy in India, if you look at it, in 1950, it was 35 years. At present, it is about 73 years. And it is going to grow further, right? If you look at this particular slide, it talks about in 2015, if my overall population was 100, by 2050, it is going to become 127. And that's what is the increment in terms of overall population. But what is shocking today is the fact that the aging population, if it was 100 in 2015, it will become 271. And that's the phenomenal growth in terms of aging population, right? And that's where we need to kind of prepare for our golden years. On the other side, if you look at the numbers, by 2050, 20% of Indian population will be above the age of 60, right? On the right-hand side, if you look at it in this slide, it also talks about the fact that in 2021, we had close to about 138 million people who are kind of dependents, which is going to become 194 million, right? So that's something which is phenomenal. Hence, we always say, and this is also the last part of the slide which talks about the aging population, which is aging rapidly. If you look at it, between 1961 to 2001, the growth was almost flat. But from 2001 onwards till 2021, it is rapidly increasing and it is going further. It is expected to grow further up to the level of 21.5% by 2031. So these are few of the facts. Now what we'll do is we will look at different age groups, because this presentation is all about, can we have NPS for all age groups? And answer is yes. So what we have done is we have bifurcated the age groups into 6 broad age groups. One is the younger population, which is the minor, between 0 to 18 years of age. We'll look at them first and their challenges, right? So we call it as generational gaps leads to financial traps at times. And what are those financial traps? Let's look at it between age group of 0 to 18. They believe in immediate gratification, right? All of us have children at home. They always believe in immediate gratification. Some of you are grandparents, so you might have also given gifts to your grandchildren or your children, right? So what do? They generally go ahead and splurge money. Immediate gratification, which is, this has gone away. Yeah, sorry. Some technical glitch, sorry. So if you look at the immediate gratification for them as, yes, let me go ahead and splurge money. But at the same time, if you look at, if we ask them to make investments in something, they will say, what is it? Why should I invest? Of course, they don't even have earning. On the other side, the financial knowledge is relatively lesser. And that's another challenge. In India, we do not teach them what is, financial planning and how do they finance or rather make the overall, provision for their overall finances in the future. Learning the discipline of saving is something which is again absent among the children, right? So these are a few questions which they tend to ask, but there are no answers to it, right? We'll search those answers as we unleash some more set of slides further. So this is one age group. Now then you have the next age group, which is the young generation, 19 to 30 years of age group. Now here, if you look at, they have the traps which are like limited understanding of savings and investments. They do not know much about it, and whatever is available, they try to only, kind of use that information to make investments. And that's where they tend to commit sometimes some amount of mistakes, and that could be investments into some kind of portfolios, or rather the larger part of their investments into that kind of portfolio which might give the immediate larger returns, but in the long run there can be a risk associated with it, which could be in direct equity or cryptocurrencies. Of course, they also have a lower salaries at this juncture, and one more challenge which they face is the fact that nowadays the younger population also will have a fact that their education loan is also eating away some part of their salary. So the disposable income comes down that way. Retirement planning is always off the radar. They don't think about it, right? And that is where the time bomb which is ticking, does not alarm them at that juncture. And these are the set of challenges which I find it as a kind of a challenge which they will face it at a later point of time. The next age group is 31 to 40 years of age, right? Now here, it's a mid-career. Hence the number of challenges are more. There we found 4, and earlier one also was 4, here we have 5, right? The first thing is urban living style of, urban living and lifestyle inflation. Malls, go and splurge money, and that's where, the larger amount of money gets kind of, I would call it as spent, but also splurge. On the other side, many may not have prioritized their retirement. And that is where, if you look at this data which talks about, India slipped to 45th position out of 47 countries in the Global Pension Index, 2023. And that's something which is eye-opener, right? Worrying about the future medical expenses. Some of them who face a challenge, like their parents, aging parents have some amount of, ailment, and that's where they also realize the fact that when we grow older, this is something which is going to come in, and hence they also get a little bit worried about, increasing medical expenses. The other point is also the fact that they also face multiple other liabilities, which could be their home loans, mortgage, children education cost, and definitely elder care. Last but not the least, and this is something which is increasing in India, autism. Yeah, there is a data which talks about 8 out of 68 children in India are autistic in some or the other percentage. And that's where the parents feel that what can I do when I'm not available, still the child could be taken care of. And that's where, one has to again have a kind of, planning accordingly. And this is something which I also feel, care for specially abled children, if any. God forbid it should not happen to anybody, but if it is there, we should be prepared. Now comes the next age category, which is advanced career individuals. These are the people who are planning various things at the same time, also having challenges which could be, creating some or the other amount of hindrances or, obstacles for them. One is unpredictable future expenses. Many of us, I'm sure in this particular hall also might have faced that I have planned X amount of investment for various, things. All of a sudden, the parent gets hospitalized, the overall insurance coverage is not sumptuous enough, and then we break some or the other fixed deposit and take care of the parent, right? So and that's something which is definitely important. And that's where unpredictable future expenses, they keep coming, and that's something which brings in the challenge. Then you also have people in this age group who become risk averse. Since they're aging, they try finding the situation that, let me take little lesser amount of risk. I might invest more into debt, less into equity. So that's something which they feel that market volatility might eat away their overall funds. But if there is a solution which allows them to have a systematic investment with a touch of higher amount of exposure into equity, yet a conservative exposure, that's something which might interest them. Fear of insufficient fund, that's something which is again another point. Only 67% Indian, or rather, this is one data which has come in from PGIM, asset manager. On the other side, there is another data which talks about 2 out of 5 Indians, they don't even plan for their retirement, right? So these are the set of, some of our facts at the advanced career individuals level. Now comes the age wherein actually people start thinking about retirement. And that is what is the pre-retirement age. By then it is, at times, it is a way too late. Some of you definitely, or many of you must be financial wizards, must be knowing financial planning and power of compounding. When you only have 10 years in hand, definitely the overall corpus which you might build might not be that good enough to take care of a larger amount of requirements of yours. Right? So here, if you look at it in pre-retirement, you have fear of being able to fulfill and accomplish all future aspirations of life, which could be traveling around the world, or also doing a painting, or becoming a runner, or anything for that matter. So those aspirations, some of those aspirations will have also price tag attached to it. And that fear comes in that whether I'll be in a position to meet these aspirations now or not. Fear of becoming dependent to their children, because now they are seeing the aging parents, or sometimes they lose parents, so they realize the fact that whether I will be in a position to help myself on my own, or do I have to be dependent on my children. And that is something which gives a financial stress further, or rather mental stress further. Worrying about maintenance of their lifestyle, and this is something which, since I've been into different sessions, but at the same time I also kind of run sessions for financial fitness, I always talk about one fact very clearly. All of you believe in SIP, you should also believe in HIP. SIP is your systematic investment plan, HIP is your health investment plan, right? So that is something which makes you little away from your overall planning for your better health, will definitely reduce your medical expenses. There is a fact which is right here. It talks about, in India, our OOP, which is nothing but out-of-pocket health expenditure, is close to about 62.6%. That clearly means that only about 35% or 36% amount is what we take it from insurance, otherwise the rest is all from our own pocket. And that definitely creates a financial distress, right? With that note, moving to the next part, which is people who are already retired, post-retirement. These are the challenges which come in. You have the retirees may feel helpless or dependent to their affected, their own children, and that, in case if the children are not supporting, they have a mental stress. Individuals also face medical expenses, and that is something which is increasing because of the fact that the life expectancy is going up. At the same time, if you look at medical inflation in India, is about 14%, and that's something which is again worrying. And life expectancy is expected to be about, in case by the time we retire and then thereafter we need to outlive, my other colleague, my other friend who was talking about the presentation, he also talked about somebody who, now expectation is up to 150 years. And that's something which I'm not talking about. Even if somebody has to live up to 90 years, post-retirement has to be, he or she has to support himself or herself for 30 good years. Yeah? So that's something which is important. This is another fact which you need to look at it, that in case if I have my expenses, which is about say 1 lakh rupees today, if I were to have the same expenses down the line 40 years from now, I would actually need 16 lakhs. Even if the inflation and overall everything is increasing at 7%. Because if you have a 7% increment into this particular value of 1 lakh, every 10 years, it doubles. So 1 lakh will become 2 lakhs requirement after the end of the 10th year. 2 lakh will become 4 lakhs at the end of the 20th year. 4 lakh will become 8 lakhs at the end of the 30th year. And 8 lakhs will become 16 lakhs at the end of the 40th year. So today, if I were to spend 1 lakh rupees as my expenses, and if I need to have the same expense, I need to meet that expense requirement of mine at the 2064, I would need 16 lakhs actually in hand. And that is something which is very important. On the other side, this is another data which talks about the health expenses for aging population. So on the, this side you will find all the developed countries which are there. That data came in from National Institute of Health on 6th of August 2020. It talks about, see the way how the overall numbers are increasing. It is about, for the age which is about 75 to 80, it is close to about $40,000 US. That's the expense. We feel that while we retire, our overall commitment will go down. Our commitment might come down, but at the same time, the expenses, the healthcare expenses, when that come in, when they kick in, it will go up further again. This is another data which talks about health expenditure per person in India and across some of the countries, the BRIC countries. It is $75 US in India, but mind you, that $75 US is only 30% of the pie, because 70% is out of pocket. Now we will get into the product called NPS, National Pension Scheme. We just saw some facts and figures and some information. Now we'll see how the product works. Of course, I can take a 1.5 hour session, but I'm given only 25 minutes time, so I'll just squeeze in as much as I can. Gagar mein sagar bharenge, right? And this is something which is a very simple vanilla product of your retirement planning. You have an investment period which is starting here, and till the time you turn 60, you keep investing. Your money gets invested in various tools, which could be equity, corporate bonds, government bonds, and alternative asset classes. And then at the age of 60, you have a benefit of withdrawing up to 60%. But I would not suggest it to be withdrawn. You can, sorry, I thought somebody's asking a question. We'll park it towards the end. Yeah, right. So 60% of the corpus can be withdrawn, but at the same time, please note the fact that you should not make withdrawals, because this is for your golden years. I'll talk about it at length as we move into the next set of slides. At the retirement age, you have a benefit of also purchasing annuity and receiving your fixed pension lifelong thereafter. This is a quick architecture of NPS which you must understand, and this is something which is important. It will also help you to understand the fact that it is a decoupled architecture devised by the PFRDA. Pension Fund Regulatory and Development Authority is the regulator, cum creator of the product called NPS. When I say NPS, it is not HDFC or XYZ company. They create a product. We are only distributors or pension fund managers. The creator of the product is PFRDA, which comes under the Finance Ministry. Then you have a pension fund manager, which is supervised by the PFRDA and NPS Trust. They are the ones who manage funds. So there are about 10, 11 fund managers who manage this particular fund as per the guidelines of PFRDA and as per the asset class selection of the respective investor. Then you have a CRA, which is a back-end processing unit. They provide you your unique number called permanent retirement account number, and then subsequently you make contribution. You can view your details there. Then you have a POP. POP is a distributor of the product. Then there are also some more stakeholders which are here. Yeah. So if you look at in this particular scheme, there are 4 asset classes: equity, corporate bonds, government bonds, and alternative asset class. Equity, when I call it equity, it is only top 200 equities wherein the money can be invested as per the PFRDA guideline, not beyond that. And that's something which makes it little conservative, not very, very, high on risk. And then you also have something called active and auto choice. In this particular scheme, you are allowed to take an active call of investing 50% in equity or 10% in corporate bonds or 40% in government bonds. On the other side, you also have a life cycle fund option, wherein, as per your age, your investment into equity, corporate bonds, and government bonds can change. And this is how the life cycle funds are. You have aggressive, moderate, and conservative. As you grow older, your investment into equity keeps coming down. But of course, aggressive will have up to the age of 75, equity exposure up to 75%. Up to the age of 36, you have equity exposure up to 75%. As you grow older, equity comes down. Same with the other two asset classes. Now the quick question comes in that can I switch between these asset classes? Answer is yes. 4 times in a financial year you can switch. In a nutshell, if we were to look at this entire product, it is not only India's, it is world's most cost-effective retirement product today, and actively managed fund today with the asset management charges of 0.03 to 0.09%. Actively managed fund at such a low rate. You can imagine, and all the who's who of the world, of the country are managing these funds, right? And that is where it is world's most cost-effective retirement product. It has been providing consistent double-digit numbers in terms of return on investment between 12 to 14%. It provides you tax exemption while you make investments. While the fund grows, that is also tax exempted. And further, it also, at the end of the term when you are withdrawing, it is tax-free. It also has an asset allocation option, which we talked about in the earlier slide. Sorry. And then it has been providing a consistent return across asset classes. And it has a fully digital automation system, right? So you can go ahead and open your PRAN, your permanent retirement account number, we call it as Prana of NPS, in just about 4 to 5 minutes time, right? Now let's understand how NPS can help those financial traps which we saw in the previous few slides. We'll take those slides quickly, one by one. Yeah, for the children, there is a product which is called NPS Vatsalya. This is a new product which was launched on 18th of September. So here, if you look at it, it allows the child to look at how the fund grows on his own. The parent, of course, will be making investments, but he will be in a position to, instead of looking at a piggy bank wherein the money does not grow, here his money will grow, or rather his piggy bank will grow, which he will get to see, right? Now, this is NPS Vatsalya, wherein money can be invested even to the tune of 1,000 rupees. It can go up to whatever amount. There is no upper limit. Definitely, it provides a long-term security to the children. At the same time, we walk the talk by virtue of providing NPS Vatsalya to the children, because they make investments and then the fund grows, right? And they get to see that, and they can also convert NPS Vatsalya into mainstream NPS account subsequently. Now, for the next generation, which is young generation, definitely it provides a balanced approach to the investment. At the same time, they can take aggressive risk also up to the age of, up to the percentage of 75%, they can make an investment in equity, right? So that's an advantage, which builds a super corpus for their retirement. For somebody who is mid-age, of course, it provides a flexibility of shifting between equity to debt, or rather having debt little, and then over a period of time shifting from debt to different other from equity to debt periodically. But it also allows you to have a tax benefit under the corporate NPS and individual NPS umbrella. For the next age group, which is 41 to 50, of course, it is an option to increase your contribution, because by then you might have done some more commitment or finished from some of your commitment. You can go ahead and take that money out and start putting in for your golden years. Now the next generation is, which is 51 to 60. It provides you to have your consolidation of investments into pension product. And this is in true sense a pension product, because it doesn't allow you to make withdrawals every now and then. And hence your kitty literally gets built over a period of time for your only one objective called retirement. Of course, post-retirement also, definitely it provides you a fixed pension for your entire life. it does not deplete. Annuity clearly means that annuity gets cemented for life. Plus, you also have a withdrawal facility, and that withdrawal can be kept in such a way that it keeps providing you a systematic lump sum withdrawal. The product allows you to have that. So how do we quantify retirement? We quantify retirement by virtue of having a retirement equal to replacement of your salary. How do you replace it? Yes, current situation, if you look at it, all of us are in this bucket. Income is equal to spending plus investing. But when we retire, what happens? Income from investments is equal to spending plus reinvesting. And this is where the older population has to think through about. Whatever money which we receive and we actually do not need it, the entire lump sum should not be kept in the bank account, should be reinvested so that it builds furthermore when we need the further stream of income from the 71st or 81st year onwards, right? And that's where it is important to have spending and reinvesting of your overall ROI. Early start, big part. This is something which is a rhyming word, but that is something which we need to think about it. How we can estimate. So suppose if somebody is monthly investing about 5,000 rupees and 10% contribution every year gets increased, and the return on investment is just about 10%, right? If somebody would have started at the age of 25, over a period of 35 years of time duration, must have built a corpus of 6.09 crores. And if you miss the bus by just 5 years and start at the age of 30, look at the difference. Your 6 crores corpus would be only about 3.20 crores. And if you miss the bus by 15 years, that means from 25 to 40, you miss, avoid, you realize the fact that it is just 80 lakhs. And if you miss the bus further, then you have only 15 lakhs by virtue of investing 5,000 rupees, 10% increment every year and 10% ROI. With this note, definitely 5 clear signs. It's time to start your NPS journey because it increases. In the increasing medical expenses, there should be something which should take care of that particular piece in terms of peace of your mind. That's something which helps you. It also, not knowing how much money you will need at retirement due to inflation and lifestyle changes, increase your longevity. So that's something for that inflation. To beat the inflation, you should have this particular scheme which will have systematic lump sum withdrawal also. Not relying on your respective dependents or rather your children. You should be self-dependent. Definitely you should not be feeling overwhelmed by having multiple choices. Have your investment at one place while you retire and then thereafter keep making multiple investments if you need to. And definitely your income while you retire, not completely, it does not stop completely. You still have a choice of still becoming a freelancer and meeting your other aspirations of life. Right? So 3 A's, with this we'll end. Awareness, thank you. I think you've been reminding, so I'll just quickly finish this. So 3 mantras while you make your investments. First of all, become aware of the product properly. It is no-brainer, it's a very pure vanilla, retirement product. Look at the types of accounts. Calculate your expenses, what you would be needing it at that juncture. That clearly means that if today which we talked about 1 lakh versus 16 lakhs, that's a calculation which you need to look at it, which 10-year slab you will be in. And then action is bring in this investment into your kitty and also keep pumping in relatively more amount of contribution into it, which will help you to build a super corpus for your retirement.